Picture this, you're in your 40s juggling family, career, and dreams of a secure retirement. Bills pile up, savings feel stagnant. What if I told you a simple, proven strategy could change that? Welcome to Smart Investing. Today, we'll build a bulletproof, diversified portfolio together. I'm your guide, drawing from decades of market data. Historically, the S&P 500 has delivered about 10% annual returns over long periods, but single stocks. Too risky, diversification spreads that risk like not putting all eggs in one basket. Over the next 12 minutes, follow Alex, a lot like you, on his journey from uncertainty to confidence. Let's start by understanding what a portfolio really is. Stay with me. As Alex stares at that blank page, he realizes a portfolio isn't a mysterious Wall Street vault, it's your personal money garden. Just like tending a family budget, you plant seeds across different soils. Stocks for growth, bonds for stability. Data shows balanced portfolios weather storms better. During the 2008 crash, diversified ones recovered 20% faster than stock-heavy ones. Alex asks, how do I diversify without overwhelm? Great question. Think of it like your dinner plate. Proteins, veggies, grains, no single food dominates. Next, we'll dive into why diversification isn't optional, backed by cold, hard numbers. You're already building confidence. Building on Alex's garden metaphor, diversification means spreading investments so one bad apple doesn't spoil the bunch. Imagine your portfolio as that dinner plate, overload on junk food, one volatile stock, and you're sick. Balance it, and you thrive. Studies from Vanguard show diversified portfolios reduce volatility by 30% while maintaining 7 to 9% long-term returns. Alex sketches his plate. 60% stocks for growth, 30% bonds for safety, 10% alternatives. This isn't guesswork, it's battle-tested. Markets fluctuate, but diversified ones zig when others zag. Curious about the data proof? Let's examine history next. History doesn't lie. From Alex's notebook, let's plot real data. A single stock like Enron crashed 99% in 2001. Undiversified portfolios dropped 50% in 2008. But a 60-40 stock-bond mix, down 20%, recovered fully by 2012, with 8.5% average annual returns since 1926 per Morningstar. Over 90% of diversified portfolios beat inflation over 20 years. Alex sees the pattern, consistency over home runs. This calms his fears. Now, what fills those slices? Stocks, bonds. We'll break down core asset classes next, making it simple. Alex's plate needs ingredients. First, stocks. Ownership slices in companies like your local grocery chain, growing 7 to 10% yearly historically. Bonds. Loans to governments, corporations, yielding 3 to 5% steadily, cushioning downturns. ETFs. Baskets of stocks, bonds, low-cost diversification. Vanguard's VTI tracks 4,000 stocks for 0.03% fee. REITs for real estate exposure without buying property. Data, 60% stocks, 40% bonds beat cash by 5x over 30 years. No jargon overload, just building blocks. Alex prioritizes. Low fees, broad exposure, how much of each? Age guides that. Selecting investments? Focus on ETFs for simplicity, ones tracking S&P 500 or total market. Alex picks Vanguard or Fidelity funds. Now, allocation, timeless rule, your age in bonds at 45. 55% stocks, 45% bonds. Adjust for risk, conservative, more bonds. Data from Fidelity, this glide path cuts max drawdown 15% versus all stocks. Stocks drive growth 10% AVG, bonds preserve 4%. Internationals add 20% diversification boost per BlackRock. Alex sets 40% US stocks, 15% Intel, 35% bonds, 10% rates. Feels balanced, but gardens need tending, rebalancing ahead. Alex's portfolio grows unevenly, stocks surge 20%, bonds lag. Without action, risk rises, rebalancing, trim winners, add losers to targets. Do yearly or at 5% drift. Schwab data. Rebalanced portfolios outperform by 1.5% annually. It's like pruning your garden prevents overgrowth. Costs minimal with ETFs. Alex schedules January review. This discipline turns volatility into opportunity. Tools make it easy. Next up. No need for fancy advisors. Alex uses free tools, Vanguard for low-fee ETFs, Fidelity for robo-advisors starting at $10K. Apps like Personal Capital track everything, alerting rebalances. Google Finance for news. Data, DIY investors match pros 85% of time per DALBAR, saving 1 to 2% fees yearly. Start small, $100 month auto invest. Secure with 2FA. Alex feels empowered. But watch Pitfalls. Alex nears finish line but spots traps. Pitfall 1, market timing 95% fail per Morningstar, missing best days halves returns. 2, chasing hot stocks lost 40% more than indexes. 3, panic selling 2008 sellers still underwater. 4, high fees erode 30% wealth. Stick to plan, data empowers calm. Alex sidesteps portfolio solidifying. Climax time, Alex builds his 10K starter. 40% VTI US stocks, 15% VXUS Intel, 35% BND bonds, 10% VNQ rates. Projected 7 to 9% annual growth, 50K in 20 years compounding. Backtested via Portfolio Visualizer, survives recessions. Tweak for you, more stocks if aggressive. This is your blueprint. Key decision, assess risk. Conservative 40-60 stocks bonds, growth 70-30, factor goals, retirement in 15 years, glide towards bonds. Stress test, worst 20% drop. Hold 3 to 5 years cash buffer. Alex chooses moderate, locks in auto invest. Data confirms, patient investors win 99% over 20 plus years. Alex's journey ends with clarity. Takeaways, diversify widely, allocate by age, rebalance yearly, use low-fee ETFs, avoid emotions. Start today, open Vanguard account, invest $100. Compound interest magic, $200 month at 8% becomes $500K in 30 years. You've got the data, the plan, build yours now. Subscribe for more, like if ready, comment your first step. Secure your future calmly.